If you're doing the backdoor Roth, you might have run into the Pro Rata Rule and wondered, is there a way to avoid paying these extra taxes because all you want to do is get more money into your Roth side? So I'm going to show you two separate ways in order to avoid the Pro Rata Rule and still get a ton of money into your Roth side of your retirement plans, which is really a double backdoor loophole. What's going on, guys? Welcome back to the channel, or if it's your first time at our channel, welcome to the channel. My name is Travis Sickle. So we're going to walk through A to Z on this stuff. I'm going to start with the Roth IRA, talk about some of those pitfalls. We're going to look at the backdoor Roth, and then I'm going to show you the two ways to avoid the Pro Rata Rule that might work and help you pay less in taxes and still get these conversions done. So let's go ahead and start with the Roth IRA. Now, if you're not familiar, the Roth IRA is a retirement account that you can put in after tax, but the benefit of the Roth is the tax-free growth that can come out in retirement. And you can do up to $6,000 or an additional $1,000 if you're 50 or older. But there are some issues with the Roth IRA, and that is the income limits. If you make too much money, you can't put money directly into the Roth IRA, but you might have already known that because you're looking at backdoor Roth strategies anyways. So those income limits for married filing jointly is $198,000 to $208,000. For singles and head of household is $125,000 to $140,000. So at $198,000 for married filing jointly and $125,000 for single and head of household is when those phase outs begin. That means you can't put money directly into the Roth side of your retirement plans, or in this case, a Roth IRA, if you make over those limits. Now, you can still do your Roth 401k and Roth 403b. If you have one, this is for the Roth IRA. So that eliminates going directly into it once you get over these limits. So what's the next thing that you can do? A Roth conversion. So there are no income limits if you don't have a workplace plan, but that is the key. If you have a workplace plan like a 401k, 403b, or even a SEP IRA, if you have these types of accounts, those are workplace plans, and that means you have additional income limits on the traditional IRA, so then you can't just put money into your traditional IRA and then convert it. But if you don't have a workplace plan, you can still do that, and that is a perfectly fine strategy. But if you do have a workplace plan, you cannot put money into the traditional IRA and then convert it. So now what can you do? You can do a backdoor Roth. So with the backdoor Roth, you can put non-deductible contributions into the traditional side of your IRA and then do that same conversion. And that is the backdoor Roth IRA. But there are issues there as well. If we put non-deductible contributions into the traditional IRA, they're after tax, and then you can convert them over to the Roth side immediately, not to have additional tax. But the issue is the Pro Rata Rule. And that means if you have existing money inside of your traditional IRA, you have to take an equal amount from both sides. So what does that look like? Let's say that we have $6,000 already in our traditional IRA from previous years, from old 401ks, whatever. Total balance in the traditional IRA is $6,000. And then you go ahead and make a non-deductible contribution of that same amount of $6,000. Well, the Pro Rata Rule says that you need to take an equal amount from both sides. So for each dollar that we're converting from the traditional IRA to the Roth side, we would have to take an equal amount from the non-deductible side and the traditional side. So that means if you want to get that full $6,000 non-deductible contribution, you're going to have to convert that entire IRA. So that means you're converting the full $12,000. So at the end of the day, you're getting a tax bill that's increasing your taxable income by $6,000. Now, it might not seem like that big of a deal when you're converting $6,000 just to rope in that other $6,000, but remember, this is the Pro Rata Rule. So if there was $600,000 in that traditional IRA, that means you would need to rope in all that $600,000 in the conversion just to get that $6,000 non-deductible contribution into the Roth side or the Roth IRA. So it is pro rata. It's an equal proportion proportion. So the greater amount that you have in the traditional side, kind of the more difficult or the bigger tax bill you're gonna have to pay if you wanna convert the full non-deductible contribution. And you might be thinking, well, couldn't I just take the traditional IRA and open up a different account and then put the non-deductible money in a different traditional IRA? Unfortunately, you can't. The Pro Rata Rule is going to loop in all of your IRAs, including your SEPs and your simples. All the IRAs are gonna get aggregated, so when you're doing that conversion, all the math is included. So there's no way to escape this by just separating it out by different types of accounts with the IRAs. All IRAs, they're going to get aggregated with the Pro Rata Rule. But there are two other ways that you might want to take a look at to still help avoid this and get the money into the Roth side without being affected by the Pro Rata Rule. So the first way to accomplish this double backdoor loophole is to put the traditional money into your current 401k. That's if you have one, and that's if the 401k will allow you to roll the money into it. So if you do that, it is no longer in an IRA, it's in the 401k. So then putting that money as a non-deductible contribution, even with the Pro Rata Rule, there's no other additional dollars to be roped into that calculation, so then you can convert that full amount to do the backdoor Roth. Well, the problem with that is you're limited to the investment choices inside of your current retirement plan at work, that 401k, and a lot of times we like that flexibility, so that's not necessarily the most ideal situation or strategy that you want to use. The second way, which is probably the way that you want to take a look at if you can, if you're a small business owner, independent contractor, or you have a side hustle, you might be eligible to open up a solo 401k. Now, the benefit here is you can roll your money from the traditional into that solo 401k and really have those same investment choices or options that you did in your traditional IRA. And the benefit here is now you don't have any money in your IRAs, and then when you do that non-deductible contribution, then it can easily go over to the Roth and you don't have to worry about the Pro Rata Rule. So as you can see, going through this stuff, there is a ton of different ways to get money into the Roth side of your retirement plans, but there's a lot of pitfalls and ways that you could accidentally increase your tax liability at the end of the year. So just do it slowly, be cautious, make sure that you're going through all the details of exactly what your situation has. If you have any questions or comments, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.